Hello, welcome back. In this session, we will discuss required rate of return on stock and why it matters and how we estimate it. So the required rate of return on stock is RS, represent the firm's cost of equity. It also return that investor required to hold the stock. So before estimating required rate of return on stock RS for the individual stock, we must first understand required rate of return on entire stock market. So the market risk premium is extra return. Investors require for their invest in risky stock instead of risk-free treasury bonds, just a risk-free asset. So it also called the equity risk premium. So the market risk premium is not directly observable. So how do we estimate it? So actually, there is three main methods for estimating. First approach is calculating historical premium and use them to estimate the current premium. The second approach is survey experts. The third is using current value of the market to estimate just forward-looking premium. So first approach is using the historical to estimate the current premium. So let's look at the historical average risk premium. So from 1960 to 2022, just the arithmetic average risk premium was 5.6%. However, the stock returns are highly volatile, which reduce the statistic confidence in the estimation. So the 95% confidence interval for the average range widely from 1.5% to 9.7%. So this large range make it difficult to pinpoint an exact expected premium. So the risk premium is highly sensitive to the time period analyzed. So different periods reflect different market conditions and investor risk tolerances. So for example, from 1960 to 2022, estimated risk premium was 5.6%. But if we look at the period from 1986 to 2022, the premium increased to the 7.3%. So this variation highlights challenge to using historical data to predict futures premium. So in addition, investor risk aversion play a key role. When investors become more risk averse, they demand a higher risk premium. So it means they require greater return on the stock. But at the same time, stock price drop because the future cash flow are discounted more aggressively. So in real world example of this was during 2008 to 2009 financial crisis when market decline were driven. So in part by increasing investors some kind of fear and demands for higher risk compensation. Okay, next second approach is survey experts. So key survey give us estimates based on different perspectives, one from the financial executives and another from the academic or industry professionals. So let's look at the Duke University and CF Magazine survey from second quarter of the 2022. So this survey gathers response from the CFO and what is regarding their expected return on S&P 500 over next 10 years. So this average expected return was 9%, but at the time, the yield on 10-year treasury bond, this is a risk-free asset, our risk-free rate was 3.1%. So subtract risk-free rate from the expected return, we can get the implied market risk premium 5.9%. So finally, so last approach is forward-looking market risk premium. So this estimates the required return on market using assumption very similar to constant dividend growth models. So usually constant dividend growth model, it assumes all distributions are dividend, no buyback, no short-term investment. Second assumption is dividend grow at the constant rate over time. So using this concept, we can estimate the R hat M, this is expected required return on equal D1 divided by P0 plus G. So here, D1 is expected market dividend, P0 is current market price. G represents expected dividend growth rate. So let's look at some issues when we use these DDM models. So first, dividend growth is not constant in the short term. While we may assume the steady growth rate over the long run, in reality, the companies adjust the dividend based on the market conditions or their profitability and economic cycles. So this makes it difficult to predict exact futures growth rate. And second, relying on the historical dividend growth rate can be misleading. So future growth depends on several external factors like inflation, population growth, and productivities. So in this reason, we have to consider not just like on the historical dividend growth rate, we have to look at the several external factors can influence on the dividend growth rate. In inflation rates, the firm may adjust their dividend differently than in the past, right? And likewise, changes in demographics and technological advancement can significantly impact future profitability and in turn also dividend growth rate. And finally, stock repurchase play a big role in dividend growth models. The firm often buy back shares instead of increasing dividends, which affect the number of outstanding shares and changes overall dividend distribution. So ignoring stock repurchase, stock buyback can lead inaccurate estimates of a future dividend growth.